Hi there, welcome to another weekly general update for the 29th and 30th of October. And we've had the continuation of this remarkably strong run in the US market, and that has led other global markets in the same direction. So the question is, what can we expect in the next few days or next few weeks? So we'll have a good look at that this morning. Just before I get into the presentation proper, just a reminder that this is general advice only. You just need to make up your own mind with respect to your own trading decisions. So the action for the week is a summary. The S&P 500 finished 3.8% higher on the week, and I wasn't expecting the market to go through the 1257 target as quickly and easily as it did, but it just shows you how strong the momentum is behind this move upwards in the US market. The price and sentiment now are at levels where you really would expect a short-term correction, but as we've seen in this rally from the lows on the 4th of October, it's really defying any kind of reasonable norm pattern, so we will just never know, but I would be expecting a short-term correction from here. Still targeting now around about 1301, which was the maximum Fibonacci level that I thought could be reached. I didn't think we'd be reaching it this quickly, but that now very much looks in play, and then I think we'll probably get a little bit more of a correction, but basically this is a pretty strong seasonal time of the year, so we quite often see good rallies into the Christmas period. Given that we've had such a strong October, we may not see quite the strength that we normally do in this period. The ASX 200 closed 5.1% higher for the week, so it actually outperformed the US market, and that was largely because there was a tremendous rebound in commodities and a very strong rebound in the Australian dollar. The Australian dollar went from 94.5 to about $1.07.5 in really just a handful of days, and that's just an amazing move in a currency. Gold closed nearly $100 higher on the week, so it was a pretty major move, up 6.1%. And that really followed through very nicely, particularly the last couple of days, to confirm the start of, I think, the new bull market in gold. So if we're looking at it at a really big picture level, I think we're now entering the final and most powerful phase of this rally that's been running since 2001, and it's likely that this part will probably go for at least another 2 or 3 years, perhaps longer. Silver did even better, as it always tends to do, so gold up 6.1, silver up 12.8, so that's another reason why I believe now that we've bottomed in the precious metals markets, because silver has really started to outperform now, so I think there's really some strong upside in silver, but it will be volatile, so you want to be buying silver, if you're doing so, on the dips. Definitely don't chase the price higher. So we'll continue to see an outperformance there, and amazingly the biggest outperformer was copper, which was 15% higher on the week. Just quite an extraordinary move, and it just shows you how much the paper futures market is being kicked around by the big players. To see copper down 27% over a period of a few weeks and then rebound 21% just as sharply bears no relation to the physical supply and demand. Now this is the ETF for silver over the last 3 months, as I don't have this chart in Market Analyst. I'll put it up here so you can see we've now formed a bit of a base in this ETF, and on Friday we just popped the head above that previous highs, the previous short-term highs, so I would say now that we're going to start to move consistently higher in silver on the ETF. You can see we're back above the moving average there. Now this is the 1 year chart of copper, just showing you the massive move. First of all down, we then formed a double bottom during October, and we've now surged higher, and we're back to about $3.75 a pound on copper. So that's been quite an amazing turnaround. Now the tin price we saw during 2010 and into the early part of this year moved up very strongly from around $16,000 a tonne to about $34,000. We've now come back to about 22, so we've had a quite significant correction, but again, the underlying fundamentals of the tin market, supply is going to struggle to catch up with demand for probably the next 3 or 4 years at least. So I think this is probably a good time to be looking at some of the tin stocks as well, which members would know about. So just a quick recap on the overall strategy from a big picture level. Obviously we'll be fine-tuning this on a day-to-day basis through the daily alerts, but when we're looking at stocks, it's definitely buying the dips, quality stocks only, and we're going into this seasonally stronger period of the year. But for me, given all the uncertainties that we've still got overseas and the fact that we're still relatively early in any kind of rebound, it's going to be the bigger stocks and the quality small cap stocks that are actually producing something that are going to see most of the benefit. Don't start going into speculative rubbishy stocks at this stage, because we might see some spikes, but they're unlikely to be sustained. So for me, my emphasis is going to continue to be on gold producers. I think we're going to see gold move higher, and we're going to see gold producers move higher at an even faster rate than gold, because they've got some serious catch up to do. Limited shorting opportunities from here on in. There will be another bigger picture correction, and it may occur into the new year, but certainly I don't think that's the case in the short term, because the decisions taken in Europe in the last week have effectively removed that potential for a really massive downside move in the short term, because there's at least a resolution that buys some time. So I don't think we're going to see anything dramatic in the short term, and therefore probably not worth shorting at this stage. But that shorting opportunity will come back. Now when it comes to metals and index trading, I mentioned this last week, this is still a work in progress. We do have a small number of the membership through the live trading room program who are participating in this. It's an almost mechanical approach to trading, and we're looking at a couple of indices and gold and silver. It's quite a short-term trading system. It's producing excellent results, both in terms of win rates, but also because they're relatively short-term trades and we turn over quite a few trades in a month, then the monthly cash flow results are looking really robust. We're not in a position to release it to the wider membership yet. I want to get some more runs on the board yet, but it certainly is looking very promising. So look out for that one. And of course, one of the other advantages is that there is zero brokerage, and you can use quite low risk per trade levels on this. So I think it's going to be appealing. So more information on that in the near future. So let's have a look at some of the charts, and we'll have a look first of all at the S&P 500 on a monthly chart. So this is going right back to May of 1995. So you can see we had a massive double top formation occurred. The first leg of it was terminated in February, March of 2000, and the second leg of it terminated in October of 2007. We then had the GFC crash. We've now recovered substantially through to 2011. We then got another correction. That correction has basically only come back to the 38.2% level and has bounced very hard. And you can see just how strong October was. October was as strong to the upside as the October period was to the downside in the middle of the GFC in 2008. So it's been a very, very powerful move. Given that, it's unlikely within the next few months that we're going to head back down again, because normally that sort of powerful move, it's likely now, I think, that we may see the markets over time move higher, but you never know. We'll have to see. Looking at it on a daily chart now, this is the October 4 low, quite a substantial turnaround. You can see here that the market went up to 1257, which was the level that I had, which was basically the retracement from the top on the 29th of April to the bottom on the 4th of October. 61.8% retracement of that was 1257. The market moved up to that level, bounced or rebounded down from it for 2 days, and then immediately turned around and smashed through it. So that's how much momentum we've got, that we didn't have a pullback in this period here. Between the 12th of October and the 20th of October, it basically just consolidated in a little shelf sideways. We then broke clear of that. We then had 1 day down, and then we're off again. So incredible power behind this move. Now I've got 1301 as a maximum retracement level. I didn't think we'd get there, and I didn't think we'd get there that quickly, but we have. And if I pan back a little bit further, you can also see that we've also got a bit of overhead resistance coming in from this trend line through here, which is at the moment sitting at around about 1320. So I think we're going to encounter some resistance between 1300 and maybe 1310-ish, and I would expect a bit more of a correction back from there, but look, anything's possible at the moment. Let's have a look at gold and silver in US dollars. So this is the gold price. We've completed this C leg correction now. This was the A leg down, the B leg back up, basically formed a double top, and then we completed the C leg, which really completed with a bit of a panic sell-off in late September. From then until just recently, we've consolidated sideways, and now gold has started to move higher. I'm expecting that we'll probably get a little bit of a pullback in gold because we had a whole week of very strong gains. The price though is not overbought yet, so it's possible gold could push a little higher. In fact, if you look at the retracement levels, we could push up to about 1772. In fact, that's quite possibly more likely, so this is more likely to perhaps turn down from here, get a little bit of a correction down off 1772, and then I think we'll probably head higher, because this is the seasonally strongest buying time of the year. Now this is silver in US dollars, so the same pattern. We had a huge sell-off on the 26th of September when there was a lot of panic about the margins being raised. Lengthy period of consolidation, and now silver has really started to move again, and you can see here that silver on the RSI is still not overbought yet, so we can still see some more upside. Let's have a look at the Australian market, the ASX 200. This is it on a monthly chart. So again, a much flatter pattern than we've seen in the S&P, and really the Australian market is nowhere near as overbought. In fact, it's really only just coming off its lows. So potentially more upside in the Australian market, and with the Australian dollar rebounding as massively as it did, we'll just have a look at that. Okay, this is the rebound in the Australian dollar, which you can see the decline from $1.08 down to 94, and then equally sharply this incredible move back up, and that just tells you how much confidence there's been in this rebound in commodity prices. You often see markets move very sharply to the downside because they're driven by fear. But when you see markets rebound in this incredible V-shaped pattern, it's indicating that fear is completely turned around, and major traders are buying with a great deal of confidence. So I suspect that we're going to see commodity prices stronger and the Australian dollar stronger for a little while yet. So let's go back and have a look at the Australian market on a daily chart now. So on a daily chart, we are getting a little bit more towards overbought, and you can see there was certainly a little bit of selling pressure came in on Friday. It's been a pretty good move. Clearly we've broken out of this downtrending channel that had been in play for the last 6 months since April. Got up to the 150 moving average and a little bit of rejection there. The market will probably not do a great deal on Monday, I would suspect, given the lead from Wall Street. And you can just see the 50-day moving average, the red line, is just flattening out and starting to turn back up again. So certainly markets looking more positive at this stage, but given the uncertainties, and I certainly don't want to be buying stocks when they're overbought, so if at all possible I'm going to be trying to buy the dips when the RSI is down closer to the 30 to 40 mark. And just looking at the Small Ordinaries Index on the Australian market, you can see it's remained surprisingly resilient through what has been a pretty terrible period. And normally you would expect the Small Ordinaries Index to do a lot worse than what it has, so that's been a pretty good sign. So that's all the charts that I wanted to cover this weekend, and we'll reconvene next weekend. Cheers.